Well, hello everyone. Today we're bringing back Greyson Geiler, advisor to Monetary Metals. So we did a short Q&A with Greyson from Monetary Metals a couple weeks ago, and although it went well, it was short, so we promised we'd come back for part two. So here we are. How you doing, Greyson?
Great. Hey, thanks, Dave. Appreciate you bringing me back. Happy to continue.
Well, thanks for being here again. So, you thought you had more to talk about on the next part two here, so I'll let you start. What do you want to talk about?
Okay, well, last video I called Monetary Metals a grassroots monetary system based on gold. And the interest rates of this system are market driven. They're not at the whims of central bankers. This week, I want to explain the moving parts of the system a little better for a broader understanding. So, when you think about it, anyone can understand why I would want to get free storage, interest on my gold, if the risk is reasonably mitigated. That's pretty obvious. I don't deposit all of my gold and silver at Monetary Metals, but it makes sense that I would want interest on a big chunk of it if I have the availability. What's not so obvious is why a borrower or leasee on the other side would be interested in their debts, so to speak, being in gold terms rather than in US dollars. So I thought I'd just jump right in with an example. Imagine you're a gold refining company and you need capital to buy the raw material, often called doré, unrefined gold, and your finished product is, 0.999 refined gold bars. Well, if you need capital to borrow, let's say you borrow $1 million to buy the unrefined gold that you're going to process. Right now, that would be 500 ounces of gold. But let's just say you borrow $1 million, and at the end, you're going to have 600 ounces of refined gold. Right now, that would be worth 1.2 million. So if the dollar price of gold doesn't change while you're processing unrefined into processed gold, you're going to have a $200,000 or 20% profit margin. And of course, you've got some costs, but you've got a big profit margin to work off of. Problem is, what if the price of gold drops 20% while you're processing it? So $2,000 an ounce goes to $1,600 an ounce. So now the 600 ounces of gold that you process, that you've have refined, now it's only worth $960,000. You owe $1 million still. You've got $960,000 worth of gold, and you've got some expenses that we didn't even address in the meantime. Well, and then what if that's just the start of a bear market and that continues? You can see the problem, right? The refiner could go insolvent.
I can see that's a huge problem. Can you walk us through the solution?
So imagine really what the refiner wants to do is have their debts and their end product denominated in the same currency, gold. So let's redo the exact same example. The refining company borrows or leases, instead of $1 million, they do it in gold ounces. They lease 500 ounces of gold, right? They buy the doré, the unrefined gold. After the refining process, they have 600 ounces, just like last time, but they owe 500 ounces of gold. They're guaranteed to have their 100-ounce margin, profit margin to work, some of the other expenses out and whatnot. But they've removed the price risk from the entire operation. Does that make sense?
Yes, 100% that makes sense. But they still have to pay gold interest on top of the 500 they owe, correct?
Well, absolutely, Dave. But remember, if they're on the other example, if they're borrowing $1 million, they have to pay interest to the bank that they borrowed that from in dollars. But there's more. The banks that are lending to metal companies, all kinds of commodity companies, they understand the price risk that the company they're lending money to are taking on. So they demand that the refining companies have a hedging program. So some of your viewers may not be familiar with hedging, but it involves short selling gold on a futures contract or forward selling gold on an unstandardized forward sell. It involves a lot of people, a lot of processes. There's no such thing as a perfect hedge. So it can really turn into a big hassle. So a lot of these types of companies are really excited that there's an opportunity to get capital where the price risk is removed.
Great. Well, I can see how many businesses would be wanting to borrow without having to take the price risk.
Yeah, I mean, we're talking about all the way from the miners, the transporters, the refiners, even the jewelry people at the other end of the whole supply chain. They're really excited to have their price risk removed. Central banks used to lease their gold out a lot more than they do now, but the Bank for International Settlements, the central bank of central banks, they updated the Basel III capital requirements. I believe it was in 2019. It really disincentivized the banks from leasing their gold out. So now for a private leasing company, the opportunity is really bigger than ever. It's really crazy when you think about it from this perspective too. I just said, private leasers. When you look at it from the angle stored around the globe, I'm talking about in people's basements, in safes, in attics, wherever people store gold, you literally have on the order of 12, maybe 13, $14 trillion worth of gold sitting idle. Monetary Metals is the only private company on the planet right now aggregating that gold and deploying it to the market as a capital asset. I mean, we're really unlocking the productivity of gold.
Wow. Thanks, Grayson. I really appreciate the intriguing way you helped us see the need that Monetary Metals is filling in the marketplace. And let's do a video soon, and then let's dive deeper into this.
Yeah, that's great, Dave. Happy to do it. Let's get a series going.
Let's do it. Thank you, G.